Hey everyone, my name is Jack. I'm a 23-year-old real estate investor and soon-to-be attorney, and on this channel I cover a variety of topics as they relate to real estate, investing, the markets, and pretty much everything as it has to do with personal finance. So if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. But today I wanted to do a bit of a follow-up video. I actually did a collaboration very recently with Brad Kaellner, the stock compounder. He has a channel that's dedicated to value investing and how to value stocks, and he graciously had me on his channel to talk about this stock right here, Equity Commonwealth. I'll actually be going through a clip from it, since in this collaboration we were talking about how to value this stock, and because it's a REIT, a real estate investment trust, it has commercial real estate in it. And it's important that you actually know how to value commercial real estate if you're going to be able to accurately value the stock itself that holds the real estate. So in the middle of it, we were going over the way to value commercial real estate, but we didn't really explain how we were doing it. We were explaining our conclusions and the basic evaluation that we gave to it, but I wanted to kind of deconstruct it here to explain how exactly you value commercial real estate, since there are a couple ways to actually value real estate, and if you're new to the game, it might be a little bit intimidating or confusing, so I wanted to kind of shore up that confusion here. But if you haven't already seen my collaboration with Brad on his channel, I'll go ahead and include a link in the description below, and I highly recommend you check that out, since it's a deep dive on this stock. If you're at all interested in investing in a REIT or stock investing in general, it's great for kind of understanding risk factors that different stocks, like a REIT for example, might be facing, and how to actually analyze a stock from top to bottom. But the stock in question is a REIT I recently invested in, Equity Commonwealth. It owns 4 large Class A office buildings in 3 different markets: Washington, D.C., Austin, Texas, and Denver. There's 2 in Austin, one's in the Austin suburbs, and another is downtown. So it is a small portfolio compared to where they were. They sold off a ton of properties over the past half decade, and now we're sitting on a ton of cash and then hold these 4 properties with no debt. That's the synopsis of it. But how do you actually value these properties? And here's how you can do it, and it really largely depends on the type of asset you're looking at. You have the sales approach. This is probably the most well understood one by novice investors or non-investors in general. This is where you look at comparable properties in a given market or given neighborhood. This is very useful for residential, where there's often a ton of very similar properties right next to each other that have sold recently, so you can quickly look at a comparable sale down the street and be like, well, that's probably what my property would sell for too, as long as it's in a similar condition. That is a very common, very easy way to kind of value real estate. The other two sort of are a derivation of the sales approach, but they look at very different factors. Whereas the sales approach just looks at the holistic sale price and will make sure that bedrooms, bathrooms, finishes are all generally the same. It's not really looking at the income potential of the property or what the property actually costs to produce. It really just looks at what did things like it sell for. Now, the income approach, the reason I say it's kind of like a modified sales approach is because you're looking at what that type of stream of income sold for. Because when you look at commercial real estate, you have to understand that you're buying an income stream. Commercial real estate, the whole point is not to live in it, it's not to necessarily speculate on it, but it's to see what is the income potential here and what would an investor pay for that type of income. So it depends on similar factors to a sales approach, in that you want to see what other income streams like it have recently sold for. And that is what's called your cap rate. That's where your cap rate comes in, I should say. And I'll explain how the actual equation works for the income approach in just a second. But that's what you're doing with the income approach. You're looking at the income potential of the property and then deriving the price from that. So really largely and pretty much wholly depends on the income potential of that property, and then how safe that income is as well. So the lower risk the property, typically the higher premium you're going to pay for that income, since there's less risk that the income would fall. At least that's would be the hope of an investor. And then there's the cost approach, which really isn't used that much. It's used more on the development side, but not really. It's taking a look at what it would cost to build a building from scratch that's like it. It's kind of useful for a very unique building that might not have a ton of income potential at the moment. Maybe if you're looking at a redevelopment project, it could be helpful to use a sort of cost approach. But again, it's really not used as much, not nearly as much as the sales and income approach, since these are much easier to wrap your head around and really make more sense, frankly. You want to know what you can sell this building for, not necessarily what you can build it for. There are a few people where that makes sense, but you want to know what kind of income is this property going to produce and what can I sell it for based on comparable properties. And both the sales and income approach largely do that. The cost approach just looks at the cost to actually construct it, which can be helpful, but again, really isn't used that much. Now, here's the basic equation for the income approach. This is what most commercial real estate investors are going to pay very close attention to when they're trying to value a property. They're going to take the net operating income of a piece of commercial real estate, an apartment building, an office building, an industrial building, whatever it is. Something that's not just your typical single-family home. Though you can use the income approach on a single-family home, it just often is not used, so it's not that useful in most cases. But the income approach is definitely used in commercial real estate very often. But your net operating income is sort of like the pre-debt profit on a building. I shouldn't call it profit, but it's the income you take in before you have to pay taxes and debt on a property. And by taxes, I mean income taxes on profits. So it's sort of like if someone were to buy this property without any debt, they just went in with all cash. Here is all of the rent that comes in minus all the expenses before you have any debt payment, because you're assuming you don't have debt. Since debt can change largely based on the buyer and you don't need to use debt when you buy a property, you can use as much as you want or as little as you can get. So it all depends. So net operating income is kind of used as the baseline for the income potential for a property. We want to know what would happen if we bought this property without any debt. How much money would it bring in? That's your net operating income. Now, the cap rate, this is where it gets a little dicey, since it's going to depend on what similar class properties in a similar market have sold for recently. So you get a little bit of that sales approach like I was talking about earlier, kind of caked into the income approach. The cap rate, in the most general sense, tries to capture what level of return is an investor seeking when they're buying this income stream. An income stream in this risk asset, in this risky market. What cap rate would someone pay for that? Because if you look at this equation and you do some basic algebra, if you move cap rate over to the other side of the equal sign and divide net operating income by sales price, that's how you get your cap rate. It's NOI divided by sales price. And that would equal sort of like an unleveraged return of sorts, if you want to look at it like that. Granted, there are a lot of other things that go into a real return on a property, but that's kind of what the cap rate's trying to get. It's whatever the NOI divided by the sales price would be. So if someone bought the property with no debt and was just looking at what the income on that property would return, that's your cap rate. So depending on the class of building, usually the higher price the building, the higher quality the asset, the lower the cap rate is going to be, because it's a lower risk thing. Because look, if you have this level of income right here and you divide it by a low cap rate, that's going to increase the sales price. And I'll go through an example with Equity Commonwealth in just a second based on the conversation I had with Brad a while ago. But that's how the income approach works. You take the net operating income and divide it by whatever the market cap rate is for that type of property, and that's going to generally be what the sales price of the property is going to be, or at least an appropriate sales price. Depends on what cap rate the investor is willing to take or willing to pay for, and that is what's going to net the sales price. So here's the video I did with Brad just a few days ago. It is a very in-depth look into Equity Commonwealth, but right here in the part where we're talking about valuation, I want to kind of get what this conversation would look like. How would you go about valuing a commercial real estate portfolio? So I'll let Brad take it away and we'll go over what I said as well, and then I'll kind of break it down from there so you see this in action.
Before that, the numbers were a little higher. So essentially what I did for the NOI is I looked at the second quarter and third quarter, just multiplied it by 2. I kind of extrapolated it out.
Sure.
And I came up with somewhere around 40 million NOI.
That's what I've been assuming as well.
40 million, okay.
They had, I think, some lease termination fees in the most recent quarter, which kind of bumped it up artificially.
Exactly.
But their occupancy is still pretty high at around, I think it was 88% across the board. So not too terrible at the moment, considering how some office buildings are really, really suffering. I think being in Austin and just being in Texas in general might help that. I don't know. Being such a small portfolio with only 4 properties, it's they're subject to more local market considerations, as opposed to having like a huge portfolio where one market swing will affect pretty much everything. But it's so localized that maybe they're kind of insulated in that way.
Yep. And I presume the high occupancy speaks to kind of the premium location of these assets.
Exactly.
And obviously occupancy doesn't necessarily mean there's people in those offices, right?
True. That is a catch.
They're collecting payments for those.
Right.
So that's good.
So the question is how sustainable are those payments if we're into this changing world with office? So that's what remains yet to be seen. That's the risk. I think the largest risk with their current portfolio. Thankfully it's mitigated with a bunch of cash, but there's a lot of questions there.
Lots of questions. The market doesn't like uncertainty, and this is there's a lot of uncertainty in this one. But there's also a lot of potential upside, right? You've got Sam Zell, you've got all of this cash, you've got a depressed commercial real estate market. Maybe not super depressed yet. I don't know what the current cap rates are for office properties around the country. Do you have any?
Yeah, I took a look. CBRE recently, a couple months ago, released their sort of market survey. They do occasionally. Sam Zell has complained that there's been not a lot of price discovery, so
Yeah.
perhaps these are still inflated or inaccurate. But let's see, I wrote it down here. CBRE has Austin and Denver Class A downtown office cap rates at somewhere between a 5.75 and a 6.25 cap.
Wow.
Which is actually up about 0.5% from last year. So you have seen a little bit of cap rate expansion, meaning the properties are worth less compared to their NOIs last year. And then suburban Class A office for Austin, which one of the properties is in the Austin suburbs, has about a 7% cap rate. And then DC office Class A cap rates are between 5.25 and 5.75%, which is about the same as last year. So you haven't really seen a ton of cap rate expansion, which would be good in this case, at least for Class A. I didn't look too far in anything after that.
Sure.
These are Class A office buildings, and that's probably where Sam Zell would be staying if he was going to stay in office. So we shall see, because he can be pretty nimble.
Right.
But but to the cap rate projection, if we're assuming that $40 million per year NOI number, and you take it at about ballpark a 6 cap, you're looking at about a $670 million portfolio. Something like that.
Yep.
And if you want to move that up to something like an 8 cap, like a very conservative 8% cap rate, you're looking at a $500 million portfolio. So I think that's kind of the worst case. So you don't have a huge margin of safety if you're assuming that high of a cap rate. If you're assuming current market cap rates and you're just looking at like the immediate liquidation value, then I'd say 670 is probably the more appropriate number if I had to put my guess on it.
A 6 cap.
Yes.
Okay.
Again, if you want to see the rest of this conversation, we don't just talk about real estate valuation. We talk about different risks going into Equity Commonwealth. Definitely check out that link in the description. But let's head on back over to kind of break down what just happened right there. Remember this formula. We have the NOI divided by the cap rate equals the sales price. So knowing that formula, Brad and I projected that Equity Commonwealth had a net operating income per year of about $40 million. That's where they're sitting. It seems like a reasonable projection. Again, we're projecting into the future a little bit, but if we take what their current NOI is and assume that's sustainable, and then you divide it by the market cap rates, which based on the CBRE projections, which they did a big study about office cap rates across the nation, they looked at each submarket, and if we kind of average that out to about a 6% cap rate, that means that the portfolio was worth just about $670 million if we're assuming this NOI with this cap rate. That's ballpark. It could be very different. It could be much higher or lower depending on what happens in any given submarket. But if we're just looking at it today, that's probably about what it's worth. So that's how we came to that valuation. And you can see the market cap rates here that I found in a study that CBRE, which is a big real estate firm, they recently put this study out about office Class A cap rates. We see the Austin cap rates here. Now remember, when cap rates go up, that means that buildings are getting cheaper. Generally, the higher the cap rate, that implies that the asset is higher risk. If we're just looking at market cap rates, that is. People are a little bit more skittish with office now because of the environment that we're in with the pandemic. It's natural. That makes sense. But when you see cap rates going up, that means buildings are getting cheaper based on their income, that is. So the same amount of NOI is going to cost you less than it did last year, according to CBRE's study. So here's the Austin cap rates up about 0.5% from last year. We have the DC cap rate down here that has not changed. And then we have the Denver cap rates over here, which have gone up a little bit as well. That's exactly what we did here. I mentioned that if you took it at an 8 cap, it would be closer to $500 million. So that cap rate, whatever you pick, is going to have a pretty big impact on the price of a particular piece of real estate in the commercial real estate space where income approach actually matters. If you're assuming a very high cap rate, that is a more conservative projection, then it's going to lower the building price. If you're assuming a very low cap rate and you get a cap rate compression of some sorts, that assumes that the building is much more expensive based on whatever the current income level is. So that's generally how you value commercial real estate. This is not the only way, but it's a very common way. You take the NOI divided by the cap rate, and that gets you the sales price. That cap rate can change based on what other similar incomes are selling for and similar classes of property are selling for in a given market. But remember, there's a lot less volume in the commercial real estate market than there is in, say, the residential housing market, where there's a ton of single family homes just in one neighborhood. Whereas in a given submarket for office, for example, like Equity Commonwealth, there might not be that many office buildings that have sold in recent years. So you have less data to kind of base your assumptions off of. So I hope this was helpful for learning how to actually value commercial real estate. It really isn't that complicated. Really, the hard part is trying to predict what that cap rate is and what an appropriate cap rate is for a given property. But that's with any piece of real estate ever. You don't want to pay too much for any property that you're getting if you're investing. And if you're selling, you don't want to sell it for too little. So it's just a never-ending game. It's just a different way to look at the real estate itself. You're looking at it as an income stream as opposed to just a straight-up sales comp with something down the street, since it depends on what the income of the property is bringing in. So if you raise the income on a piece of commercial real estate, you'd expect the sales price to go up, assuming the cap rates stay the same. One last reminder to check out that collaboration I did with Brad. It was a lot of fun, and we got really into the weeds on Equity Commonwealth. So if you're thinking about that stock for whatever reason, it might be a good place to start some of your research, since we go over some of the stuff on their balance sheet, what's going on for the future, what they're planning. There's a lot of in-depth analysis on that one particular stock, so if you're interested, definitely check it out. Of course, I'm not a financial advisor, so don't base your investment decisions on my analysis. Definitely do your own research. But that's all I've got for today. If you like this video, please like it, since it helps the channel out a lot, and definitely subscribe so you don't miss any new updates, since I put out new videos every single week about real estate, investing, the markets, and pretty much everything as it has to do with personal finance. And definitely check out the links in the description below for Webull and Robinhood. You'll get free stocks when you sign up for those platforms. And with Webull, you have to add a little bit of money, but you don't actually have to use the platforms long term. You get free stocks, I get free stocks. It is a win-win, so definitely get it while the money is there. But until next time, take care.